Tell me why I shouldn't be preparing my portfolio for a recession right now. The 3-month rolling total of Challenger Gray and Christmas job cut announcements is at the highest level since the global financial crisis.
One, the job cut announcements have not translated into actual job losses as measured by initial jobless claims. Two, if the job losses were to start, it's possible that the Trump administration would pivot on tariff policy, which could be a boost to markets.
If the labor market doesn't hold up and equity markets take another downturn, can I trust bonds to be a diversifier within my portfolio?
Most likely, yes. While the Fed has said they're on hold for now, we think they're good for 4 to 6 rate cuts over the next 12 to 15 months, and would probably cut interest rates more aggressively if job losses started to pile up, even if inflation is running above their target.
But what are some of the other areas of the market that might be attractive in this environment? Hello and welcome to the Outlook by STRAT. Mike, uncertainty remains the name of the game in global markets and global economies. Just 1 month ago when we were filming the last edition of the Outlook, we were talking about our recession signal activated. Various areas of financial markets were pricing in a recession. And we were talking about how it might have been too late to de-risk with how quickly it moved. A lot's happened since then. Let's check in on what markets have done since the initial reaction to Liberation Day.
At the lows on April 8th, the S&P 500 was down 21.3% from its recent all-time high. In a typical economic recession, the S&P has a drawdown of about 33%. So you do the math there and you say that's about a 64% implied probability of a recession. That was pretty dire, and the market arrived at that conclusion very quickly.
Right.
And at that time, as you said earlier, we said that the market's priced in such a bad economic outcome so quickly that perhaps the time to de-risk had largely passed. And that, of course, is how it played out. From there, the news flow, the rhetoric around tariffs started to improve, starting with the pause on the quote-unquote reciprocal tariffs for 90 days. And then now trade agreements are starting to be rolled out and telegraphed. And as we sit here today, the S&P 500 is only down 7% from its all-time high. So that's only a 21% implied probability of a recession. So it's possible here. It's highly probable that the market at one point was pricing in too dire of an economic outcome, and now it's not pricing in enough probability of a recession, and the truth is somewhere in the middle.
Yeah, a lot of oscillating for the market. We, of course, have our recession signal, one of the goals of which is to not oscillate this much day to day, right? But to that point, the recession signal is now not active, right? The market stress signal a month ago was active to that recovery you've been talking about. S&P 500 now inside of 10% down from its high. Stress signal inactive. How, if at all, does this change how we're thinking about the situation from a portfolio management standpoint?
It doesn't change it a whole lot. You'll recall when our recession signal activated on April 3rd, we said, all right, we get it. The yield curve signal has been active for a long time. Let's take that with a grain of salt because for whatever reason, its recession forecasting capabilities have been somewhat diminished since COVID. Right. So market stress was the new signal that triggered. We wanted to see that corroborated by the real economy data starting to break down or the labor market breaking down. And we were going to wait until we saw signs of weakness there before we felt very confident saying, okay, an economic recession is coming. And that still hasn't happened. And because that hasn't happened and the rhetoric around trade has improved on the margin, markets became less stressed. But we're still sort of in the same situation here. If the hard data in the labor market or the real economy break down from here, markets will get stressed again, and the recession signal will activate. But this time, we would probably have more confidence that an economic recession is likely.
Yeah, exactly. Those are going to be the things we're looking at closest, right? The real economy and the labor market signal, trying to determine if the hard data will start to be impacted. What we're looking at here, breaking out the hard data, actual spending numbers versus soft data, survey-based feeling numbers. What we're starting to see is in headlines around the soft data is turning over. The soft data is struggling. And while that's true, the soft data never really recovered over the past couple of years. We've been in this sort of doldrums from a vibes perspective. But But the hard data is what we're really focusing on.
Right. And this is the typical pattern you see when there's an event-driven shock to the economy. The markets shoot first and ask questions later, right? They react to the shock, whatever that was. In this instance, obviously, it was the tariff announcement on Liberation Day. Then the soft data starts to break down. Businesses start to say, hey, I'm not seeing good things right now. If this continues, if these vibes continue to get worse, I'm going to have to make some tough decisions and lay some people off. Consumers are saying, I don't like what I'm hearing. I don't like what I'm seeing. Maybe I want to save a little bit more money. And the vibes are low. The vibes have been low, as you said. We've been in a vibe session since 2022. The key is, does the soft data, which has much worse track record in terms of predicting recession, does that eventually feed into the hard data? Do the vibes get so bad that people actually start making layoffs, actually start, stop spending, saving money? That's a tougher bar to clear.
Right.
Yeah.
Right.
And we're not there yet.
Yeah. And that'll be the next big consideration. Generally speaking, from a soft data standpoint, if a consumer has money to spend, is still on the payroll, they're going to be spending at least a portion of that money. The soft data may cause them to save more, but they're still going to be spending. Right. So
that's the big thing.
What becomes critical to us is the labor market. And here's where we can see, some of the divergences and what could be coming in the future. Initial jobless claims staying relatively flat, but this Challenger Gray and Christmas announcement, pretty significant.
Yeah, the 3-month rolling sum of job cut announcements is at recessionary levels. It's at levels last seen during the global financial crisis. Has not yet translated into folks actually going and filing unemployment insurance claims.
Right.
So for one reason or another, either these folks haven't been laid off yet, or they're quickly finding other jobs, which that would show up in the non-farm payrolls report, which has been reasonably strong, but it's lagged and subject to revisions. Or they're just finding income elsewhere and they don't need it. But for whatever reason, it has not translated yet. So this puts an investor in an extremely difficult position, because you would look at this chart and say, all right, there it is. That's all I need to see. Those job cuts are going to translate into people losing their jobs, and we're going into a recession. And so I'm going to start de-risking my portfolio right now. The thing is, if you do that, once we get to the point where the firing actually starts and the initial jobless claims are rising, and it'll be driven by a tariff shock, so prices are going to be rising too, that environment will be so unpopular amongst voters that we think that will likely be when the Trump administration starts to look for off-ramps pretty aggressively and looking to make trade deals and turn things around. They do not want to inflict a recession on the economy. That's still our base case. So if you followed this chart and said, I'm de-risking right now, you could be de-risking right into the policy pivot by the Trump administration, and you would most likely regret it. So we're taking the approach, because of the unique times that we're living in and the situation, that you should prepare for a number of different outcomes. So within an equity portfolio, what looks good if the trade rhetoric continues and the economic data doesn't break down and we avoid recession? Small caps. They are the cheapest, and they would be have the most upside potential in that environment. What if we just muddle through this uncertainty for a long time? Large caps with defensible business models, quality type companies look good. What if the dollar keeps depreciating and investors keep diversifying into other assets and the rest of the world just looks more attractive? Things denominated in foreign currencies look good. Foreign stocks are cheap. So owning a good amount of those and making sure you're not off sides with your overall risk level. We don't think this is a green light to be adding to equities. We don't think it's a red light to be de-risking either. You want to be at a appropriate level of risk and make sure you're diversified. And then the last piece is, can you trust bonds? If there's another downturn, if the hard economic data actually breaks down and equity markets pull back, can you trust bonds as a diversifier? And that, of course, starts with, what is the Fed going to be able to do?
Yeah. And you talked about the potential for a Trump presidency pivot, right? Generally speaking, if the Fed were looking at an environment like this, they may want to have some proactive cuts, but they're a little bit more hamstrung,
right?
Primarily because of inflation uncertainty. right? So we've talked about tariffs and how they can have a significant impact on near-term inflation. But what we think is most important to the Fed is controlling those longer-term inflation expectations. And those seem to be in check still, but there's definitely a communication aspect and a timing aspect of how the Fed could potentially cut rates to not confuse markets.
Right. So if we put ourselves in the chair of the Fed, and I know a lot has been said about how this is the most difficult environment to be a Fed chair. Okay, just take a formulaic approach. What you're going to do is say, all right, where are rates at today? 4.25% to 4.5%. Where is neutral?
Right.
Long-term neutral. That we think is at about 3.25%. So we're about 1% above neutral. So you should want to get towards neutral if you're confident that inflation over the medium term is going to get towards your 2% target, and that the unemployment rate is going to be near your long-term target in the medium-term time period as well. So how are those things looking? Well, inflation, because of the tariff shock that's going to show up in the Q2 inflation reports, that is going to be nowhere near the Fed's target.
Right.
But if you look 12 to 15 months out, once they drop out of the year-over-year comparison, that would look more like the endpoint of this without tariffs line. You end up in the same spot. You're about 2.3% on core PCE. Your target's 2.
Yeah.
That's not that bad, right? And then you look at the unemployment rate. We're at 4.2. The long-term target is 4.2. If the labor market hangs in there, that's not that bad either. You should be at neutral.
Get to neutral.
So we look at this and say, the Fed, if the labor market hangs in there and the inflation shock dissipates, it doesn't escalate from here, which it doesn't seem like it is, and long-term inflation expectations stay anchored, they're good for 4 to 6 cuts.
Right.
The thing is, how quickly are they going to deliver them? If the unemployment rate starts to rise here relatively quickly and the job and firings start and initial jobless claims rise, they're just going to front load them. They'll go for the 6 and they'll start doing them quicker. If the labor market hangs in there, they might have to wait until the price shock of tariffs is out of the inflation numbers before they can justify cutting, but then maybe they'll do 4.
Yeah.
Either way, 4 to 6 cuts is not bad, and we're not talking about hikes.
Right. Right.
So the idea of the Fed is so hamstrung they can't cut in the event of an economic downturn, we think that's, it's ridiculous.
Yeah.
They definitely can.
Yeah. It'll just be a timing and communication thing.
Exactly.
Right.
Exactly.
Yeah. Yeah. So potential for some conflicting signals to the Fed here from inflation in the job market, but in our view, certainly a bias towards cuts.
Absolutely.
And almost certainly more cuts than the market is currently expecting, given that bias and the potential for the labor market to struggle.
And for that reason, we think bonds and duration, fixed income should be a decent diversifier if equity markets break down from here.
Makes sense. All right. Well, that will do it for this edition of The Outlook by STRAT. If you have any questions or comments, please feel free to reach out.